got rates dropping fast, folks. You know that. Investors have been reaching for yield. Both the S&P utilities and the REIT sector hit historic highs last week. I said historic. But there are a lot of different ways to play this dividend ETF story. Lots of different ways. You can go, for example, for the highest yield possible, which is what the Global X Super Dividend ETF does. It currently has a dividend yield of 7%. Look at that. It includes companies like Altria, Fortress, AMC, Philip Morris. Or you can go another route. You can go with companies that are consistently raising dividends but don't necessarily have the highest dividends. ProShares S&P 500 Dividend Aristocrats. I know that's a mouthful. It's an equal weighted index with constituents that have increased dividend payments annually for at least 25 years. So which is the better approach? Dave, what's your thoughts?
So very, very different portfolios. It's almost a shame we have to put them in the same bucket. Something like the Aristocrats is really a play on core, quality, almost sort of old economy stalwarts. The yield on this isn't amazing. It's 2.5%, about 0.5% over what you get in just buying the S&P. But what you're getting is sort of those core stalwart quality companies. Something like super dividends, you're investing in small caps, you're investing in mid caps, and it's kind of a yield overall strategy.
So what could go wrong here? What could go wrong with buying super high yield? Maybe they'll cut the dividends?
Well, they could cut the dividends, or maybe that dividend is looking so high because the company's been hammered for a reason, and it's a value trap. So you really have to be a little bit careful what you wish for here. If you really need that 7% yield, do you want to take this kind of risk?
Mary Ann, 7% yield, that's even higher than most high yield funds right now. High yield funds are about 6%.
Correct. So really it comes down to also valuation, right? A lot, and it has to do with the low interest rate environment. A lot of retirement clients need income. So they've been chasing what we call bond substitutes. This higher yielding fund tends to incorporate bond substitutes. That's driven the value of the stocks up. If you want to have growth of your dividend over time and buy things that have better valuation, we're going with the pocket that has dividend growth. So we're directing our clients to really focus more on the dividend growers.
We think there's a lot outperforming, though. I mean, in theory, it makes sense. If you want dividend, go with high-quality companies that are slowly raising their dividends, and not those that pay high dividends because they have to or may be at risk. And yet, do we see a lot of outperformance? Does that strategy actually work long-term?
It's not so much about long-term, it's about where we are in the cycle. And the interest rate environment we're in, we haven't seen since the 30s and the 40s, where the 10-year Treasury yield was really hovering around 2%. Yeah. And we have the largest population that's moving into a retirement that has demand for yield. We've never seen this supply and demand imbalance before.
I probably get more emails on should I stay in my high dividend ETF or my high dividend fund than any other question that I get. Just people stopping me on the street. A lot of people are in high dividend at 6%. Is there a risk? Now, we all know that if the market economy turns down, those are at higher risk. They tend to act like stock funds. Right?
I think people need to remember that the dividend yield is just one half of a ratio, and the other one is the price. Yeah. And so a lot of the times you see companies come up with these crazy, awesome-looking yields. It's because their stock has been hammered. So your question about performance, one of the reasons people look to those Aristocrats funds is over the long term, they protect you in down markets, and I think that's what a lot of people are looking for with dividends is safety.
So Mary Ann, you got to answer the question because I get it asked all the time. I have HYG, they write to me. That's the high yield ETF, one of several. Should I hold on to it this year?
So talking to our analysts, as long as spreads are contracting, the high yield market is going to continue to do well. So we've actually been in the high yield market for some time. We've been actually recommending it selectively.